We all listen to the news. We all hear what all the so-called experts in the media are telling us. And they're saying, look, hold the course, stay in equities, keep buying stock. There's nothing but up, up, up. Stocks don't fall, they always rise. Then the other side of the coin is when the market got weak about 90 days ago, when the Iranian war started and the Strait of Hormuz was shut down, and things looked really, really bad in terms of rising inflation, rising economy, no more interest rates being lowered. In fact, now the talk is maybe interest rates ought to be rising or be higher in the future than they are today. So what you hear all the time when that happens is you should buy the dip. You should buy the dip because stocks are on sale. You should buy the dip because the weaklings got out. That's why the stock volume's down. That's why the stock value's down, is because those that are fly-by-night retail investors, well, they don't have the stomach for it, so they got out. That's the only reason why it gave up 5, 10, 15%. The truth of the matter is, though, if you look at professional traders, they never chase a stock lower. They buy on value all the time, every day. What is the value today? What they perceive the value to be tomorrow. And if they bought a value today, but something changed or shift in the valuation, it doesn't mean because the stock is cheaper, it makes it better. It means they have to reconsider it. They're reevaluating the risk-reward component. You take a look back at the 2008 crash. There was a lot of stocks, a lot of public companies that had major, major decreases in their value. Now, some were legitimately drugged down by the market as a whole. But if I throw a weight around a bag of air, it may or may not sink depending on how much the weight is. But if I get enough weight at the end of the rope, whatever that bag of air is, it's eventually going to go below the surface of the water. That's what happens in a really downward trending market. You get enough sellers. I don't care what your stock is, what the value you pay for it. I really don't care what the stock's projections look like. If you get enough selling and enough negative exiting out of a public market, it's going to drag down essentially virtually all stocks in that market. It's just a market mentality. It's a herd mentality. Give you a prime example. General Motors went bankrupt back in the 2008 crash. General Motors, really? Bear Stearns gone. Lehman Brothers gone. Major, major public companies, bonds worthless, bankruptcy, devalued. Billions upon billions of dollars lost overnight or essentially in less than 90 days. All the things you think cannot happen. Well, that was lost net worth. That was lost value in the market to never be had again. We're talking, I don't even know in today's terms, probably be $1 trillion worth of value in 2026. Nothing anyone expected. No one could project it. No one could detect it. And it happened in a matter of a flash. But we haven't had a crash in 16 years. No one even knows what that looks like. Most young investors sub 45 years old can't even spell the word crash because all they've seen is good times. Let the good times roll. But when I think back to it and I start thinking about buying the dip, I think about catching a knife. I think about, you drop the knife from a second-story building. It's like, I got to catch it. Either I'm going to get stuck in the finger with it, I'm going to catch it with the blade, slice my hand, I'm going to miss it altogether. That's a precarious way to run your investment portfolio. So whether it's the media telling you to buy the dip, take stocks down, don't worry, stocks are resilient. They always come back. I listen to these guys on Fox News. I'm losing a lot of respect for them because they obviously think that we're all idiots. They think that we have no way to determine with street smarts what looks good or bad. Now, don't get me wrong. Many of you are going to listen to this and still play the market. You're going to push it to the limit. You're going to stay in the market as active as you can because you're going to be able to trade out of it. You got sell provisions. You've got all kinds of different methods to get you out of the market as fast as you can. Here's the problem. 90% of people in the public market have no clue what they're doing. It's in through their retirement account, financial advisors, trust funds, hedge funds. They're in place because they have a much longer time horizon. So when you think about catching that knife, you got to ask yourself, well, why am I catching that? Why do I want to take the risk to be in a market overly exposed when maybe some of the strongest red light indicators on the dashboard are starting to flash pretty heavy red? But somebody says, don't worry about the red lights. It's just your landing gear. You can still land without gear. Don't worry about your lights. Your wings are okay. It doesn't matter that the right wing has a bolt off of it. The fact is a red light is a red light for a reason. It's tied to something fundamentally part of that market or that particular situation that says, I should be paying attention. Now, if everybody in the market says they're an expert and they're all telling you to stay in, the one lesson I've learned over 41 years is when everybody else is going left, I should be going right. Everybody's going right, I should be going left. You know what falls behind a whole herd of horses going through a pasture from one pasture to the next? A lot of manure, because they beat it to death and they wear it down. There's not even grass to eat. So when this market is heading one direction, it may be a flashing light that says, I don't want to follow the uneducated 90% retail investor going left, because that means when it exits, they're all going to try to get out of that burning theater at the same time. They're all going to want to exit. When they do, they're going to sell. To me, the stock market reminds me of a condominium complex. I was in a condo project years ago, and I had a great asset, bought it at the right price. I used it for business. All of a sudden, I realized the market turned down in 2008, and the value of my condo dropped by 30, 40, 50%. I said, I don't care. I'm holding it anyway. I don't care what the value is. I use it for business. What I then figured out is, wait a minute, there was a lot of ancillary negatives to being one of the only owners that was paying my HOA dues and my fees. All of a sudden, the swimming pool was rented out to everybody else downtown because the building owner couldn't afford to pay his bills because so many condo owners couldn't pay their HOA. And other people who had financial stress started selling their condos way below market value because they couldn't make the payments anymore and they didn't want to get foreclosed on. So it realized for me is that even though I had a great building and a great condo, I was a victim of the crowd mentality. I was a victim of the weakest condo owner in the complex. You're the weakest. You're going to be the victim of the weakest stock players, the equity players in the market. The moms, the pops, those are trading stock, the young kids, the sub 45-year-olds who've never been through a crash. And when they panic and they all run for the exit of the stock market at the same time, don't be surprised that stock market doesn't drop from 52,000 on the Dow to 35,000 on the Dow in 90 days. Do not be shocked. It's done it again and again and again over the history of the stock market. Now, I'm not anti-stocks. I own SpaceX, I own Exxon, I own Procter & Gamble. They're stocks that I own. But I buy those stocks because I'm going to own them forever. I don't have any intention on selling any of those. So when I think about the dot-com example back in the 1990s, again, probably way before many of your time, sounds like I'm talking about World War II. The dot-com failure was the same thing that's happening today in the tech world. It's as if there's 100 horses in the race, and we all assume all the horses are going to get to the finish line. Some are trying to figure out who's going to be in the top 25% of those winners. Some are trying to be real specific on who's going to be in the top 10%. Some are trying to pick the top 7, which are carrying the market. 63% of the public market growth has been through the top 7 tech stocks in the Dow. So the question is, will all 100 get to the finish line? No. Will 25% get to the finish line and offset my losses from the other players in the game, the other stocks I've invested in, the other stocks that are part of my portfolio that are winners or losers within that mix? And does my selection of those 25 out of 100 winners get me where I want to be? My point is very simple. Do what you do for you and do it based on what you know. But I know you shouldn't be chasing a dip. You shouldn't be buying on a down market because fundamentally the experts will tell you it's not what you pay, that's called price. Value is what you get. And I know this from my own personal investments. Value is what you're willing to pay for something because you believe it's there. And you have to have the patience and the fortitude, and you have to have the ability to understand that markets rotate in cycles. I don't think the average investor in today's market for the last 15 to 17 years understands time is the real cure for most investments. I also want to remind you, sometimes cash is a better investment than public equities. Thanks for listening.